I'll start this afternoon session with an interesting story. In the late 18th century, in the Himalayan ranges, there was a small, tiny, dark cave. Inside that cave, there was a monk, Indian master, spending his time in long hours of meditation. He had very limited resources and he was happy with himself and engaged his time in deep meditation. There was a downpour of rain one of the evenings, resulting in a number of uninvited guests invading into his cave. And they are nothing but rats. They have invaded into the cave and started troubling him. One of his dhotis, one of the two dhotis that was the only possession of the monk, was completely bitten and spoiled by these rats. The master thought for a minute, and the next day morning, he ensured to bring a cat inside his cave. Seeing the cat, the rats ran away. He was happy and resumed his meditation again. It was only very short-lived because the new entrant brought by the master, the cat, was energetic and quite enthusiastic also. It started jumping all over the place, even jumped over his lap few times, made all kinds of sounds. Like we also listen in the nights, some of the cats mew, making sounds that disturbs our sleep. Our master also has got disturbed because of this rat. He then decided and tied the cat over a pole. Thereafter, he was very happy in meditation. A few days later, a young Zen master, whom we see here, came to the Indian guru meditating in the cave. This Zen master is interested in learning the art and the practice of the Indian meditation as per the Indian standards. Therefore, he came in search of this guru living in the cave. The guru was happy because he can impart his experiences to this young man. So he taught him laboriously all the nut and bolt of the meditation, and the art and the theory and the practices also was given to this young man. This Zen master had a very keen eyes. He observed everything, including the cat tied over the pole. Then the Zen master took leave of the Indian master, and the Indian master also blessed him that he may succeed in his journey of meditation and self-realization. The young Zen master returned back to his monastery and plunged into meditation. He saw to that and ensured that a cat has been brought and tied over a pole before he starts the meditation. That is what we see here. Friends, copying has been prevalent time immemorial. Copying was done by even monks. Students copy in the exam, some of them, and pass. What about the corporates? Do the corporate also copy? And what is the plus and minus of copying? Is the copying all along harmless, or sometimes it can be harmful? As a part of the corporate copying, we are required to prepare the financial statement for the current year. The practice is copy the last year financial statements and start replacing the current year numbers so that current year figures are ready, the financial statements are ready. Now, if you, without care, like this Zen master, start copying, it can be quite harmful because the government, through Ministry of Corporate Affairs, have made changes in the while preparing the financial statement and requiring mandatory disclosures in the financial statement for the current year onwards. Friends, we will spend the next 1 hour or so in understanding the requirement related to the mandatory disclosure of the financial statement. Let us move into the subject proper. The source for my today's presentation is the notification brought by Ministry of Corporate Affairs dated 1/4/2021. We are almost near 1/4/2022. The fond hope is that everybody had taken a note of the notification and therefore they will comply with the requirement of the notification. Just as a freshening up of our memory, I will go through the notification and also the need thereon, so that if there are any lapses are there, which we can do it in time, so that we can also save a lot of embarrassments. The agenda is like this. The financial statements of the company are prepared as per the format given in Schedule 3 of the Companies Act. Most of the often small companies honestly believe that the preparation of the financial statement, including the notes and accounts and the details to be given, are the responsibility of the auditor. But the auditor knows very clearly the basic responsibility as per the legal requirement, as per the law, rests with only the company. So therefore, we can no longer play around saying that and blame the auditors or the company one against another. So the law says that the financial statements are to be prepared as per Schedule 3 format, and the responsibility rests with the company. Therefore, as a participants, all of you are from companies. Therefore, it will be very useful to you. That is the reason we are presenting it. Normally, in the financial statement, in the notes and accounts, we start giving only the information like the copycat. We copy and then replace it. Most of the items will not go under any change. It will go as it is. Like a significant accounting policy. What is the depreciation policy? What is the revenue recognition policy? What is the employee benefit policy? What is the tax policy? These things doesn't change anytime at all. It remains constant. What are all the events happened after the balance sheet date is also provided there. So therefore, we tend to think that nothing more to be done except to copy and change the relevant numbers appearing in the books of account. Friends, that is not the case. Please reserve your understanding till the closure of the presentation. I am sure that this presentation will be very, very useful to you. Some of you might have already be aware of these disclosure requirements. Then you can validate your understanding. Those who have not read it and fondly wanting to receive this information, be with me. I shall ensure that you get every piece of the detail which are required under this particular notification. All that notes which are carrying from last year will continue. In addition to that, additional regulatory informations are required in the financial statement by way of a disclosure. So far, we have only understood that the companies, once they are incorporated, are governed under the Companies Act, and the requirements of preparing the balance sheet and profit and loss account is also as per the Companies Act. Friends, kindly note, this additional regulatory information requirement travels much beyond the Companies Act and also integrates with rest of the few law. So therefore, I shall definitely discuss with you those relevant points at the relevant point of time. Now let us move to the further details inside. Companies adopt accounting standards. Companies adopt Ind AS. Companies, those are non-banking financial companies adopting Ind AS, are the three divisions which is forming part of the Schedule 3. Schedule 3, you go inside, you will find that three divisions are there. Accounting standard following company, Ind AS standard following company, and NBFC following Ind AS standards. Now, the disclosures which we are going to discuss for the next 45 minutes or so applies to all the three types of companies. So let us move into the details of each of the slides. Each of the slide has got each point I shall discuss with you. The first one is borrowed funds. A few weeks before, a client of mine approached Punjab National Bank and obtained a working capital facility of 5 crores, which was made available to him, and he can draw at any point of time. Working capital facilities are given for the purpose of deploying those money for the purpose of buying raw material, paying to the creditor, etc., paying salaries, paying electricity bills. A few days later, after receiving of the sanction letter, this client has received an offer for possible buying of an adjacent land and building of his factory, which could be a very good expansion plan for him. For a while, he struggled. Now to buy this land and building at a throwaway prices because the seller is having a pressing needs for fund. Therefore, he is going to give me this property at a throwaway prices. Now to fund this buying of the property, if he goes to go through again another bank with application ready, he thought that it is going to be a cumbersome process. They will ask so many questions and it will be time consuming. By the time the property may get out of my hands. Therefore, he put 1 + 1 = 2. That means funds available from Punjab National Bank on account of working capital, factory available, the land and building available next to the factory. Therefore, he put 1 + 1 = 2. He used these funds for buying this property. He is satisfied himself and he is happy, thinking that after all, I went to the bank for my business purposes. They also gave me for the business purpose by acquiring the adjacent property. That is also for my business purpose. Friends, this thinking is little bit defective. So far, there was no need for any disclosure in the notes on accounts of the financial statements of the company. Now, this new requirement, mandatory requirement says that if the borrowed funds are not utilized for the purpose for which the loan was given, the deviation is to be reported in the form of notes in the financial statement. So therefore, this client has to report saying that I borrowed the money for working capital. I have used for buying the land and property. So much of money has been deviated. He has to report. What is the consequence of this reporting? Banker, seeing the audited financial statement, will immediately recall the loan with the interest and also will levy a penalty. On the other hand, a company which goes to the market and raises its capital by way of a issue of a securities, and he has got the capital raised, he has shown a purpose, expansion of the business, some purpose he has shown. And if he is not going to use that capital for the purpose for which he has taken, he is also required to disclose the deviation from not using the money raised for capital, he has to make a note. By way of bringing the borrowed funds also in par with the capital, now the government has put whether it is a borrowed funds or whether it is a capital raised from shareholders, if there is good, as far as the end use is concerned, if it is not used for the purpose for which it has been taken, then the company has to disclose in the form of a notes in the accounts. So what is the lesson we learn from here? Whether it is a capital from shareholders or funds raised in the form of a loan capital from the bank, use it for the purpose for which you have taken it. Otherwise, what will happen? You are required to disclose in the notes and accounts. So therefore, that is a learning point we need to understand. The next point, property, plant, and equipment. When you take a balance sheet and then read on the asset side, you will find first item as a fixed assets. The second item as an investment. A company's tangible properties are grouped under the fixed assets as the case may be. If the immovable property is kept as an investment, then it will be grouped under investment column. The recent amendment, there is one which we are discussing, the ministry requires the company holding an immovable property. We are going to limit our discussion only with reference to immovable property in this particular discussion. So company having an immovable property has paid the consideration to the seller. Therefore, the seller has handed over the property to the company. And the company went before the sub-registrar and got the ownership transferred and registered in its name. This is one kind of a immovable property. The second kind of immovable property, the company has paid consideration, has got the possession of the property, but there are more than one owner. Therefore, company is holding a part of the property as a joint owner. What is the extent of that joint ownership is required to be disclosed. Then there may be immovable property. Let us say a person, a company has paid the consideration and the seller has also handed over the possession of the property with an understanding that the property will be registered in a week's time. By the time the week had ended, the seller also has ended his life because of a COVID conditions. So what is the situation as at the end of the year now? Company has paid the consideration, property possession has been given, but not yet registered. That kind of a property is also to be disclosed. Property, immovable property in the possession of the company for which registration has not, for the ownership has not been transferred in the name of the company is required to be disclosed. The company have got a property and there are some disputes are there on the ownership. The nature of dispute also is required to be disclosed in its notes and accounts. There may be certain properties which are actively put to use by the company, or there may be certain properties which are removed, retired from that kind of a active usage. Those details also is required to be disclosed in the notes and accounts. So far, this kind of disclosures were not required. Now they have become mandatory. A natural question will arise in your mind. What is that? Sir, I am holding a property in the company's name. Company has not paid any consideration for the property except that they have given a deposit, rent deposit, and we are paying only lease rentals month after month. Whether such details have to be disclosed or not. The authorities have thought over that and they have said that in the case of leasehold properties which are covered under a registered lease are excluded from this kind of a disclosure. Therefore, owned properties Property is still not, ownership is not there, but considerations have been paid. Joint ownership. Fourth one, items which are excluded are leasehold properties are excluded. If there are any disputes, that also is required to be given here. In other words, each of the properties jatakam has to be given in the notes and accounts. So that is the learning point here. The next, I am just moving as we go forward, so kindly travel along with me. In the case of a company, that it can be property, plant, equipment. I'll take an example out of the three, and the rest of it you can make out your own examples. 40, 50 years back, a person has bought a property, piece of land in a very important location. Now this property has been recorded at its cost even today after 40 years as rupees 1 lakh only. But the market value has grown multiple times or multiple crores of rupees. To reflect the fair and correct view of the balance sheet of its assets and liabilities, the promoters decide to revalue this property. Maybe they can also revalue the plant and machinery if it is valuable. So therefore, this property has been revalued. Where a company has revalued its plant and machinery, property or equipment, or including the intangible assets for some reason, they have to disclose whether such a revaluation has done by a valuer under the company's valuer and valuation rules 2017. A disclosure is required. Imagine another situation. So there are valuers who are registered valuers under the company's registered valuers rules 2017. So therefore, whether this revaluation has been done by one such registered valuer is to be required to be disclosed in the notes on accounts. Company has revalued the property through the registered valuer. This has to be given. Company revalued, but not through registered valuer. Still, a disclosure is required to be given. A company following Ind AS, the company has bought a property for 1 lakh 40 years back. It is recorded in the books of account and it is not revalued as in the earlier case. You can continue to show at 1 lakh in the books of account as the cost of the property. But the fair market value of that particular property, which is running into crores of rupees, is disclosed in the form of a note in the notes on accounts of the company. And such a revaluation from 1 lakh to 100 crores has to be done by an independent valuer. That independent valuer, whether he is a registered valuer under the company's valuation and registered valuer rule 2070, is also required to be given. In the previous item, company has restated. In the second item, the company is not restating, only giving in the form of a notes on accounts. So whenever the learning point is, whenever the company revalues its property, plant and equipment, it is required to do it through a registered valuer, and the information is required to be disclosed in the notes on accounts. So far, we have covered. The company has got resources and it can grant loans to whom the directors, promoters, key managerial persons are the related party of the company. The word loan will also include giving guarantee or giving security. Based upon the securities, this promoter director can elsewhere raise a loan. When a company gives a loan, what is the expectation of the company? It can define, saying that you are taking a loan today, when will you repay, and what is the interest you will pay, and what shall be the EMI you will give. So therefore, we can specify the terms of repayment of the loan. Alternatively, no specific terms have been defined in this transaction between the company and the directors. Or an understanding is that the loan shall be repayable on demand. Whenever the company is calling for the loan, the director shall repay. So these are the three situations. So no specific terms have been prescribed, kept open, or payable on demand. So far, all the three categories, whatever the loans which are outstanding, as at the end of the year, they get reported as a part of related party transactions under accounting standard 18. That continues. This disclosure requirement says that if there are specific terms are not arrived at, or the loans are payable on demand, then the company is required to disclose two things. One, what is the outstanding amount as at the end of the year under these categories: director, promoter, key managerial person, and the related party. And that outstanding loan as a percentage over the total loans given by the company. So therefore, this information is a eye-opener for the lenders or for the investor, that how the company's resources are parked in the hands of the management, namely directors, key managerial persons, and the related parties. This requirement was not there earlier. Now it is required to be given. So whenever, what is the learning point here? If the company is going to give loan, it can draw a specific arrangement for repayment of the loan and the terms of payment. No disclosure is required. If no such arrangement, specific arrangement is there, the company is required to disclose this information. This information has got a connection with another slide which is coming afterwards. I shall relate that with you. What do we see here? A lovely baby, smiling, twinkling eyes, holding a feeding bottle full of milk. Maybe that is the reason it is smiling. Milk is required for nourishing the baby to grow. Wonderful. Now what do we see? A elderly person is also drinking the milk, thinking that he will further grow. But we know that is not the case. Drawing the parallel, in a company situation, companies develop work in progress, that to capital work in progress, by feeding its resources into the capital work in progress. Companies also develop intangible assets such as software and schemes like that, systems. There also the company pumps in resources. As of now, if you take out this block and see, you will find a number of projects are inside this bucket. Some of them are growing, never ending. Some of them are suspended, but we don't know ourselves. It is inside the mix. So therefore, the law decided to bring out a disclosure by way of escalating the details. What kind of details are there? The details are aging schedule. Each of the capital work in progress and intangible assets, how many projects are there? And the projects are done what purpose? They will get completed soon and they will start yielding income. Now you yourself look at it and then see whether how long these projects are going on and give the schedule of it. 1 year old, 2 year old, 3 year old, and never ending goes on. Also see whether there are any projects which have been suspended from the time it has started. It has come halfway through or 3/4 through, and then for no reason or for some reasons known to the company, it has been suspended. If so, what are all those projects which are suspended? Is that enough? When we start a project, when the company starts a project, it also budgets. What kind of a budgets it can do? It budgets for the cost, estimated cost. Is that enough? It also budgets what is the estimated time by which this project will be completed. So therefore, at this point of time when the disclosure is required, you will be surprised to find that some of the projects are cost overrun. You estimated X amount. Now you have dismantled, and then seeing the nut and bolt of each of the project, you find that some of them have cost has overrun. You estimated X, today it is X plus. So that has to be disclosed to the government. Then timelines also overrun. You thought this will be over in 1 year, 6 months, or 2 years. Now you find that those timelines have already gone. Now still the projects are going. Like that elderly person sucking the milk. These projects are also consuming a lot of the resources of the company, which are otherwise productively can be used by the company. So this requirement is required to be given by way of a disclosure in the notes on accounts. So the lesson, what is the lesson to be learned? Whenever the company is going to embark on bringing out a capital work in progress or doing a project under intangible asset, ensure a timeline, ensure also budget of the cost and remain within that, then there is no issue. Otherwise, this can be an issue. Issue from whose angle? Even from the lender's point of view, even from the investor point of view, even from the management point of view. This can be a white elephant eating all the resources of the company. Therefore, government want to draw the attention of all the stakeholders, especially the management, to this particular disclosure. Okay. Imagine a CEO decided to buy a luxurious apartment for his family. He takes the family, wife, parents, children, everybody to the apartment, proposed apartment, go through the apartment n number of times, and they are feeling very happy. Yes, we will have this. And the CEO arranges all the funds, everything is ready. Day after tomorrow is the registration, and the sale deed has to be prepared. At the time, his wife says that, darling, whose name you are registering the property? Then the CEO thinks that my funds are from my account. I am going to repay the loan. It's better that I buy the property in my name. But she says that it is wise to buy the property in my name. If you say no to the wife, lifelong problem. If you say yes to the wife, again a problem. You have to face the Benami Prohibition Transaction Act 1988. So therefore, when a person buys the property and pays the consideration and gets it registered in some other's name, owner is different, the beneficiaries are different, then that is called the Benami transaction. So in this case also, you will find that immovable property is held by a person, his face is not known. So before drawing the parallel, just to set the anxiety risk, I would say that Benami Properties Prohibition Transaction Act 1998 Act gives an exemption saying that the consideration can be paid, property can be registered in the name of the wife. It is outside the scope of Benami Transaction Act. So therefore, very well register the property in wife's name. You will have peace not only from wife but also from the Income Tax Act. Otherwise, you will have PIECE only. So therefore, that is a Benami Transaction Act. Now, in the case of a company, for our discussion purpose, whether the company has been issued a notice under the Benami Transaction Prohibition Act, whether the action has been initiated or any action is been pending as on date. So therefore, now they are not initiating, but already they have initiated, therefore the proceedings are there. Then the company is required to give a disclosure in the notes on account, what is the property and whether the property is recorded in the books of account, who are all the beneficiaries, and what is the nature of the transaction and what is the status of the proceedings before the Income Tax Act, and what is your view with reference to the proceedings has to be provided in the notes on accounts. So what is the moral of the story? In the case of the company, let not a person enter into buying of the properties or holding the properties under the binami as a binamidar. Now you find that in cinema, we find double role. Rajinikanth playing double role. Shivaji Ganeshan playing double role. Sometimes he has played the maximum of 9 roles also in a cinema. So therefore, the double role is one person is trying to impersonate the other person. What happens is even in corporates, that kind of a double role is going on. So the person has got a frowning face. He doesn't like the situation. And the other face, he has got a smiling face. The smiling face, he shows to the banker. Actually, his face is a frowning face. What is the transaction situation here? A company goes to the bank and obtains a loan against the current assets. Current asset means what? Inventory, raw material, stock in trade, finished goods. Based upon this finished goods levels held by the company, the drawing power of the company borrower is fixed. Suppose you hold 100 crores worth of current assets, the drawing power may be 75%, 25% is the margin. So they can fix the drawing power. For that, what is the requirement from the company side? The company is required to submit a quarterly statement of the stocks held by the company. If the company has submitted such quarterly statements, what can be the outcome of such a statement? The statement can contain numbers which are in agreement with the books of account or not in agreement with the books of account. If it is in agreement with the books of account, this slide does not apply. If it is not in agreement with the books of account, thinking that we will give one statement to the bank and have the highest DP available, draw the money and then use it. When the problem comes, dekha jayega. So we will see at that time. So therefore, now is a part of another law being integrated, IBC being integrated here. So therefore, if there are any discrepancies, give a summary of the major discrepancies and also state the reason for why there is a discrepancy. This has to be given in the form of notes in the notes on accounts. So what is the lesson learned from here? The company, when they avail a loan from the bank and agree to give a quarterly statement, ensure that they are in agreement with the books of account. Otherwise, at the year end, we have to start reconciling it. In practice, they give some statement to the bank, and at the year end, they struggle to match with them. So that is not advisable. A defaulter, a willful defaulter. This person has gone to the bank and obtained a loan. Suppose he doesn't have a money at the time of repayment of the installment, then he is called a defaulter and his accounts will be marked as a non-performing assets. A person obtains a loan and repays in time and his account is called performing assets. A third scenario, a person has obtained the loan, he has money to repay, but he is unwilling and he is not willing to repay, then he is called as a willful defaulter. Once a company has been declared as a willful defaulter, the company is required to give in the notes on accounts that they have been declared as a willful defaulter, and what is the nature of willful default involved has to be given in the notes on accounts. What is the consequence of this? If the balance sheet of the company is going to have that he is a willful defaulter, his probability of raising further capital or his name and reputation in the eyes of the shareholders and the stakeholders will be bad and worse. So therefore, what is that lesson we learn? Whenever we borrow money from the bank, repay it in time, and don't be a defaulter. Don't be a defaulter. Don't never be a willful defaulter. A going concern, a going company, or a company which is presently working, doing business. Sometimes they also incorporate some subsidiary company or associate company. And that associate company or the company which is newly formed, to that, this existing company starts giving loan or paid the capital, or some money is receivable from that, some transactions are there. The newly incorporated company, because it is not operating or it is not doing business, it may be handed over. It may be application will be handed over to the registrar of companies to remove the name of the company from the registrar, and it is called a struck. This name is struck from the registrar of companies. It's like a skeleton now. It doesn't have any flesh and blood, therefore it cannot act. So far, there was no requirement for any disclosure with reference to companies associated and got stuck with the registrar, whose name has been stuck with the registrar. Now, the new mandatory requirement says that in your company, as a company, have you got any relationship with the stuck company? Have you formed a company and got it stuck? And what is the nature of transaction? Any receivable, payable? Still, are you showing and thereby enjoying some limits with the banks or not? And whether you are still holding some investment in the form of a share capital, whereas in reality, the company has been struck. These details are required to be given in the notes on accounts. What do we see here? A rabbit and a tortoise. Rabbit is known for running fast. Tortoise are known for going slow. In corporate also, we have got rabbits. They run fast. This particular corporate rabbit had run fast and obtained a loan from the bank. And it thought that that is the end of the game and went for sleeping. But the law requires the company which has borrowed money from the bank or a financial institution to register the charges of the assets given as a security to the bank with the registrar of companies in favor of the bank. So you have to go to the registrar of companies, get the charge created in favor of the bank. 30 days time is given from the time the loan has been sanctioned, agreement has been signed. Another 90 days extra time is given. If it is not done, pay with additional fees. Beyond 120 days, the charge can never be created at all. It becomes a default, permanent default. On the other hand, suppose this corporate rabbit, having got the loan, registered the charges, went for sleeping, but saw to that the loan has been repaid in full along with the interest, and the loan also has been repaid. Now the rabbit thought that everything is fine. I can go happily and then sleep. Banker, as far as he is lent, he has received the money. What is my problem? Therefore, I will go to sleep. There is a requirement under the Companies Act. Wherever the corporate has repaid the loan, they have to obtain no objection certificate from the bank. There are no more dues are there. And that no objection certificate has to be filed with the registrar and cancel the charges originally created against the name of the company. This is satisfaction of charge, unlike the registration of charge, has to be done within 30 days of satisfaction of the loan. So therefore, as such companies may have charges yet to be created, timeline barred, 120 days gone. Companies have satisfied the loan, 30 days have gone, so therefore satisfaction not filed. These two cases, they are required to make a note in the form of a notes on accounts and disclose. What is the consequence of such notes? The registrar of companies can, after seeing these notes in the books, in the financial statement, can issue notices to the company. And what can be the outcome of that? the company can be levied with a penalty, and also the officer of the company can also be levied with a penalty. And what is the lesson we wanted to learn? Within the next 15 days of time, 20 days of time, if you have got any pending charges to be created or pending satisfaction to be done, kindly take it up on a priority basis and get your books clean so that the reporting requirement will not apply to you. What is the lesson? Whenever the company borrows money, get the charge done within 30 days of time with the registrar of companies. If the charge has been satisfied, file the satisfaction of charges within 30 days of time to avoid giving notes in the notes and accounts, and also to save from any penalties concerned. A company makes investment in other company through investment company. It is permitted to have 2 layers of investment company in India, but you may be under a situation where the downstream investments may be made through more than 2 companies. If so, the company is required to give a notes and accounts of the downward investment companies whose SIN numbers must be given. Up to 2 layers, no reporting is required. More than 2 layers, the reporting in the form of a notes and accounts is required to be given. This is again a contravention under the Companies Act. It can invite penalty notices from the registrar of companies. Financial ratios. Those who are coming from commerce background would have studied the ratio analysis, the formula and the method of doing ratio analysis when they were in the +2 or maybe in the BCom. Those who did CA and CIMA and professional qualifications also would have learned these ratios. And at the time of going to the bank for raising certain loans, we may use 1 or 2 ratios for the satisfaction of the banker that the company is capable of generating profit and also cash liquidity, and therefore will be able to repay the loan in time. Satisfying with that, the banker will lend the money. Thereafter, there is no application for any of the ratios whatsoever. Now the Companies Act requires every company to compute 10 ratios and disclose it in the form of a notes on accounts every year. Okay, we can do that. What is the problem? The problem is that the company is also required to calculate the 10 ratios for the previous year. Okay, that also can be done. What is the other problem? If there is going to be a variation of more than 25%, that also to be disclosed. So therefore, calculate the ratio, disclose it. If there is a discrepancy more than 25%, that has to be notified. The biggest challenge is that what are all the items which are going in the numerator or the denominator is also required to be disclosed here, so that other person can understand this is how the ratios have been calculated. The lesson to be learned is that whenever an item is classified, a transaction is classified in the books of account, ensure that it is classified under the proper head of account. It is no longer beneficial to throw the transactions haywire here and there, and at the year end struggle to explain the ratios. So therefore, ensure proper classification, also ensure the ratios are calculated. What is the other benefits of these ratios? It is beneficial to the stakeholders, investors, and also to the banker, even to the management. If the indicators are going to be little haywire, your attention can be drawn so that you can set it right. Like the speedometer in the car, where the petrol levels are dropping, you go to the petrol bunk and put the petrol. Like that, suppose current ratio is showing certain variations, you can address yourself and set the ratio properly so that as the car can go smoothly, your company can also go smoothly. Companies draw schemes of compromise and arrangement with the creditors or with the members, and they are approved by the competent authority. So far, there was no requirement for any disclosure in the notes on accounts. Now there are 2 disclosures are there, whether the scheme has been accounted and it has been accounted as per the accounting standards applicable. And if there is a deviation, that requires to be explained in the notes on accounts of the company. So therefore, this applies to companies which goes for scheme before the tribunal. Company has got share premium. How does the share premium comes? Company raises its capital by issue 10 rupees share. It issues for, let us say, 23 rupees. The 13 rupees is a share premium. How that share premium has to be used is prescribed under the Companies Act. Only for that purpose it can be used, not for any other purpose. Similarly, company goes and borrows funds from the bank. Sometime back, I referred a discussion saying that we will have a link. This is the link. So therefore, the company, once it borrowed the funds, you know, and I know, the funds have to be used for the purpose for which it has been borrowed. If it is going to be for other than the purpose, then there is requirement. Yeah, disclosure is required, resulting in the loan can be recalled by the bank. So therefore, here we have got a situation where a company is there and a person is standing. He is a promoter, he is a director or a key manager person. Now the company has got the funds and he wants the funds, and he also wants to see that his name doesn't get reflected in the form of a reporting in the notes and accounts. Therefore, how to do that? He thinks very ingeniously, and he says that if I take the money from the company directly, I am coming under the radar of reporting. So therefore, I will go behind the transaction. What do I do? The company will give any loan. To whom? Grant loan to an intermediary. In the intermediary, none of the company's persons are there. Okay, one layer done. He is not satisfied. This intermediary by itself or with the consultation of the company will identify a second intermediary. The second intermediary may be an Indian company or it can be a foreign company, foreign entity. So therefore, company to intermediary 1, intermediary 1 to intermediary 2. What does the intermediary 2 does? There is an understanding. The loan received from the company through the intermediary 1 shall be lent back to the ultimate beneficiaries. They can give a loan, they can give a guarantee, they can provide a security with which this person can go forward. So therefore, we are preparing the accounts, we are preparing the financial statement for the company. The company in its notes and accounts has to say on what date, how much money was given to intermediary 1. And what did the intermediary 1 did with intermediary 2? And what did the intermediary 2 did with the money with reference to ultimate beneficiary? This has to be reported in the notes and accounts. What he thought he can be covering, now the whole thing will be opened. In addition to that, the company also must give a declaration that the company has complied with the provisions of FEMA. One intermediary 2 from coming from abroad. So therefore, the company has followed the provisions of the FEMA law, and the company has also complied with the provisions of money laundering law, prevention of money laundering law. So as I said earlier, the Companies Act is integrating information with reference to money laundering law and FEMA law. For a change, instead of preparing the financial statement for the company, suppose the ultimate beneficiary happened to be a company, and for which, if suppose we are going to prepare the financial statement, instead of giving the loans and securities, now this ultimate beneficiary has received the fund. The intermediaries and the companies are not funders. So therefore, now we have to intimate saying that from what is the details of the funders of the company, intermediary 1, intermediary 2, and the company. And you also have to declare saying that whether he has received any security or a guarantee, and a declaration saying that the provisions of the company's provisions of the money laundering law and that of the FEMA law has been complied with. So therefore, this is a requirement. Now, if you carefully say, I am in Mount Road, I go to Tambram, and from there I go around and then come back to Tambram, to Mount Road. Now, this is called round tripping. Similarly, in the case of money also, it can happen in the form of a round tripping. If there is such round tripping, they are required to be disclosed in the notes on accounts. So what is the lesson we learned here? Once this kind of borrowed funds and share premium account, which are having a specific purpose, is used for other than the purpose for which they are there, they have been used, then it will give a wake-up call to the banker as well as to the registrar of companies to look into this matter. Therefore, the lesson to be learned is that never embark on this kind of a transaction in your company. If you had embarked on, come out of it. So what do we see here? A lovely bungalow and a Innova car. It is lovely and wonderful to have a Innova car in front of the bungalow. But the Innova car having the tag of Government of India, Income Tax Department is not desirable. It is a bit scary. The background is that the company enter into transactions and the transactions are recorded in the books of account and it is disclosed in its books in the return of income, and that applicable taxes are paid. Now there may be transactions which are not recorded in the books of account and they are found out by the Income Tax Department during the process of a survey or searches, and the company now decides to surrender and disclose this undisclosed transaction to the department and pay taxes. Now, the mandatory requirement under the Companies Act is that in respect of such undisclosed assets or the transaction which are offered to tax before the income tax law, whether now you have recorded the transaction in the books of account or not has to be given. One exemption is given. Some time back, government came out with a scheme called Vivada Viswas scheme, under which one can go for a surrendering of things. Litigations can be surrendered and the discount taxes can be paid, and immunity was given. What is the immunity? No penalty, no interest, no prosecution, no going behind the jail of the promoter or the director. So therefore, if you have disclosed those information under the Vivada Viswasa scheme, this particular requirement does not apply to those companies. So exemption given for items which are disclosed under the immunity scheme brought by the government, they are not required to be given in the form of a notes on accounts. So what is the moral of the story? Whenever transactions are there, record them properly and pay taxes on that. If there are any undisclosed transactions are there, first place never entertain them. And if you had to entertain them and then entered into the transaction, see that the taxes are paid and also make a disclosure in the notes on accounts. So they have integrated IBC, integrated FEMA, integrated money laundering law, and also integrated income tax law under the Companies Act. So no longer we can show one return to GST and another return to income tax and file something else for the ROC. All these things are not going to happen. All of them are integrated or getting integrated. So many items what we discussed with reference to the balance sheet. Now there are going to be 2-3 slides on account of a profit and loss account. What are all they? Eligible companies coming under the provisions of Section 135 of the Companies Act is required to spend 2% of their net profit after tax on the corporate social responsibility. So far, the requirements of disclosures were forming part of annexure to the director's report. Now, there is a specific requirement on the company to disclose some mandatory requirement in the form of a notes to the profit and loss account. What are all they? As of now, we disclose certain things on managerial salary paid, auditor fees paid. Like this, certain things we also disclose. Foreign exchange income earned. Like that, we disclose. Now, under the CSR also, certain information have to be disclosed. What are they? Amount required to be spent. Amount of CSR incurred during the year. So, provided for and obligated and incurred. Shortfall, if any, some of them have money, but they don't get a project. Therefore, they were not able to spend. Is there any shortfall at the end? is there any carryover shortfall from the previous year? So therefore, this is a total shortfall has to be given. And the reasons for shortfall. COVID, projects not available. So many reasons can be given peculiar to the company that have to be given there. Nature of CSR activity, education, poverty elimination, illiteracy elimination, like that there are 12 items are there in schedule number 7. What is the policy of the company with the CSR projects undertaken? While doing the CSR implementation, it can be implemented by the company by itself. With the staff, with their own staff, they can do that. Or it can also be implemented through a trust registered with the income tax department holding 80G and 12A registration, or a section 8 company holding registration with the income tax department can be the implementing agencies. They are also required to register under the CSR implementing agency in CSR 1 form with the registrar of companies. So therefore, you can spend your money through one of these agencies. And in the implementing agency, if there are related party of the company which is giving the funds are found, then the company is required to disclose saying that here is an implementing agency, I am giving the contribution to them, they are implementing the project. But in the implementing agency, my related parties are sitting there, that information must be given. Sometime at the year end, the project may be spilling over more than 1 year. The company may end up doing a provision in the books of account. CSR account expenditure debited and the CSR payable account is credited. If there is going to be a payable account, amount spent out of the payable account in the form of a movement must also be given in the notes on account in the form of a notes. Cryptocurrency. This is a buzzword of the day. Individuals, they invest or trade in the cryptocurrency. People make huge profits and it did not disclose or disclosed partly because there was no clarity how much income tax will be levied, whether dealing in the cryptocurrency is a permitted transaction, legal transaction, was a doubt in the minds of Indian public. Now the government has said that gain or a profit out of the cryptocurrency will be taxed at 30%. And as and when it is sold, it will be taxed. Now, how do we know how much a person has invested, how much he has sold, and what is pending with him? There was no integration. Like the individual, there are cases where companies have invested or traded in the cryptocurrency. So far, there was no requirement for disclosure. Now, this mandatory requirement says that company must say whether they have invested or traded in the cryptocurrency. And if so, what is the profit or loss there of the transactions done during the year? And what is the closing balance? Idea is that you may put X amount of money, and out of that X minus 1 you would have sold, and the system would have given you some bonus of 3. Therefore, X minus 1 plus 3 is equal to X plus 2 would have come. So therefore, we have to disclose this X plus 2 here. We do not know what is the consequences of that. The income tax department may say that on sale or on the bonus at the time of receipt can be taxed. So therefore, implications we have to wait and see. The requirement under the Companies Act is that you have to disclose invested, traded, profit, loss, and the closing balance. Further, the company may receive deposit or an advance from its customers and use that money for the purpose of trading in cryptocurrency. That person can say that I am individual, not trading. I give the money to you, you trade and then share the profit with me. So therefore, that kind of a deposits are received with the year tagged, year marked for cryptocurrency transaction. That deposit or allowance is also required to be disclosed. So therefore, if you are thinking, if you are already in cryptocurrency transactions, kindly see that it is being reported properly. As an individual or as a corporate, we believe in physical notes. We believe in tangible notes. Now the credit cards have become fashion. Sooner, the cryptocurrency, the virtual currency will come to life because the Reserve Bank of India is also regulating, Government of India also giving okay signal for this kind of transactions. So therefore, let us get familiarized with this crypto transaction and also benefit out of them. Here, the limited need is that company is required to disclose them. What do we see here? A corporate executive engaged in meditation. Individuals do meditation at homes and ashrams for the purpose of getting peace of mind and productive in his life. But when an individual sits in meditation at home, what is the actual happening? His mind is filled with not meditative thoughts, but worrying thoughts, because there has been a lot of gaps in his transaction in the corporate world. Having listened to the requirement of the additional requirement of the government, once that has been done in letter and spirit, in time and complied with, a corporate executive need not go around looking for a place to meditate. Even the very same boardroom can be a meditating place, because there is no worry, because there is no lapses. Everything has been complied with. Maybe there are some things government may wanted to have a clarification, and we are ready to meet the clarification by submitting the clarification. If still notices come, we can challenge them even at the Supreme Court. Therefore, the boardroom with a meditating executive can be a wonderful scenario for each one of you to dream, inspire, and be engaged with. I enjoyed dealing with the subject with you. I'm sure that you also enjoyed the presentation.